how it all comes together.
I'm getting goosebumps right now because the way you're explaining it, I always saw it as disconnected. I have one question.
Sure.
So if I understand it right, I'm new still to this, but I understand it that the CAD, the Canadian dollar, is like kind of Swiss oil backed, right? And so, and how you explain it is that since the oil prices at the moment they're really soaring, that has a positive or a upward effect on the CAD. Did I understand that right?
Correct.
Okay, and so how is that how does that affect the Swiss currency?
That oil price doesn't necessarily affect the Swiss. We're looking at strength, how it supports the strength of the CAD, right? And so your Swiss franc, right? Your Swissy, right? Can act as a safe haven. We'll look at so for example, if we come down, right, and I was holding until we got $2 Swiss. So if you come and you take a look at the Swiss, right, we can see that the Swiss franc weakened towards its lowest levels against the dollars and is pressured by an aggressive Fed. Okay, so all currencies are being pressured by the Fed. So, but when you look at the Swiss, right, what's going on from a monetary policy perspective, okay, investors continue to assess, right, the possibility of further tightening by the SNB, the Swiss National Bank, after annual price growth numbers came in at 3.3% for September, below expectations of 3.5. Okay, so now investors are starting to speculate. Well, their price growth numbers came in less than expected. Are they going to continue to be hawkish with hiking rates? And we see that the SNB, right, raised its rates by 75 basis points at their last meeting. And that lifted borrowing costs into positive territory for the first time in 11 years. Okay, in 11 years. So when they're getting price growth numbers that's coming in below expectation, what that's telling investors is, well, their inflation isn't as bad as it is in other places. So maybe they're not going to be as aggressive in regards to hiking rates in the future. It's all about what's going to happen down the road, right? By the time you get to rate hikes and things like that at a current policy meeting, a lot of that's already priced in by the market, and they're looking at what's going to happen down the road, right? So you've got the CAD on one hand that just had good employment numbers and jobs numbers that came through. You've got, yes, it's a commodity currency. Commodity currencies usually take a hit during times of negative sentiment, right? During times of recession fears. But it's the commodity for Canada is oil, right? And we know, right? So we can piece it all together. So we come down to crude oil. We can see crude oil soared 4.5% on Friday, near 5-week highs, up approximately 15% on the week. OPEC agreed to cut production by 2 billion barrels per day, or about 2% of global supply for November, in a move that threatens to squeeze supply, right? So if supply is squeezed and the demand is still there, okay, that's going to push the price up further ahead of the winter session. The output cut could be the largest since the start of the pandemic. On top of that, Russia warned that it will not sell oil to countries. You see how it all comes together.
I'm getting goosebumps right now because the way you're explaining it, I always saw it as disconnected elements, but the way I see it now, it's like this machine, not a machine, but like it's as if all these parts are interconnected, and as one fills, it gains weight and it drops and lifts the other one, and there's like this like balance.
Okay, and when we look at what's going on from a monetary policy perspective, okay, with the Swiss franc, you tend to lean more towards the CAD right now. Okay, so the only thing that can combat that, which will put that CAD Swiss into a range, is that if things continue to decline, war in Ukraine, recession fears, something pops off fundamentally that just really increases those recession fears, then that can strengthen the Swiss franc, because the Swiss franc is a safe haven, place where people like to park their money in times of fear. And that can
Oh,
cause it just a whipsaw, right? So a couple different scenarios that can happen, but based on the current price action and where we are now, right, we're looking for this bullish wave to continue to push up for the CAD.
so you're looking at the commodities linked to the Canadian dollar, like the crude oil, but at the same time you're looking at the sentiment, the VIX or whatever it was, and how that's tipping, and also, as you said, the monetary information, and if I understand it, like you said, a safe haven. In the training, you also say the yen is a safe haven. So do I understand it right? Like if stuff is going down in Europe, like you said, with the war and these things, people would naturally want to move their money into these safe havens. So that would basically strengthen the Swissy. Is that how you mean it?
Yes, that's one possibility for sure. One scenario fundamentally that's happening. Yep, that's an example. And then also global recessionary fears, right? Because of inflation is so high. So inflation being high, right? When you look at the stock market, right, it's going down. Why? Because the Fed is saying, hey, one of our tools in our belt to combat inflation is to continue to raise interest rates. Why? Because we have to get money out of circulation. We have to slow down the spending. Okay, so when you look at spending from a consumer perspective, inflation is high, my money is worth less, right? I can't buy the most bang for my buck, my currency, right? Because of inflation is high, prices are going up. So they've got to tame inflation. What happens when consumers don't spend, right? Companies that sell products to consumers, right? Automobiles, groceries, everything, right? They start to lose money. Things start to tighten. If I'm a company and things start to tighten and the Fed is raising rates, that means if I want to expand, what do companies usually do? They borrow money, right? They borrow money from the banks. Well, if interest rates are going up on the money and the money's not as cheap, then I'm less likely to borrow that money, which means what? Contraction. So I might not be willing to invest in that new facility that can create jobs and expand our company at this time because, right, recessionary fears, inflation, the interest rate is too high. So that creates a contraction. So you just move in market cycles, right? You have these boom and bust periods, then you have these recessionary periods, right? Where things is just the free market at work. So things start to tighten, and then there's certain entities that are going to benefit during times like that, and then there's certain entities that won't benefit, right? So if things are tightening, it creates less demand, right? Then there may be a less, like for example, the Australian dollar, the main commodity is iron ore. Iron ore is the main ingredient when you're talking about making steel. Its largest partner is China. China, right, buys that iron ore. Why? Because China for the last few decades has been expanding, building like nobody's business, modernizing. Well, if China's economy starts to suffer, right, as we head towards a recession and they start to contract, well, there's going to be a less demand for that iron ore from their largest trade partner. So the Aussie, right, on top of things that are happening domestically, right, due to inflation and housing market woes and things like that, right, starts to weaken. And that's what you're seeing. Got it? You see how it all comes together.
I'm getting goosebumps right now because the way you're explaining it, I always saw it as disconnected elements, but the way I see it now, it's like this machine, not a machine, but like it's as if all these parts are interconnected, and as one fills, it gains weight and it drops and lifts the other one, and there's like this like balance, the way you explaining it, and dependencies between all of them. That's thank you so. Wow.
You're welcome. Yep, we're all connected. We say it all the time. We're all connected whether we like it or not, period, right? And it's amazing, right, how certain countries, for a period of time, want to move more towards isolationism. That's becoming impossible, right, to be isolated, regardless, right, of where you may lean politically, because it's a global economy. Right? It's a free market at work. So we're all gonna have to deal with each other. So there's no use in pointing the finger, just find solutions, right? If problems are man-made, man can solve them, okay? And that's what we're going through right now. So I got a feeling that we're gonna be all right, all right? We're just dealing with the ebbs and flows of the free market, okay? Which is why the market moves in waves. So it's one thing to just look at technical analysis, it's another thing to understand why the market moves the way it does. Yep.
All
So
right, so
welcome.
that's what you mean with the fundamentals in the trading, because you said in the trading it's the fundamentals that move the technical side of it.
Yep. Yep. You have to have a catalyst. You have to have a driver, right? The market just doesn't move because it moves, right? So that's what we're looking at. And the dollar is the world's reserve currency, right? So most commodities and things are traded in US dollars, right? That's why you have oil, they call it the petrodollar. Okay, so the dollar has the ability to flourish in times of growth and high growth, but then in times of fear, the dollar can act as a safe haven. So if we come here and we look at the US bond yields, right? We see that the bond yields are moving up again. It went up over 4%, it came down, and now it's looking to push up again, right? Because the dollar can also act as a safe haven. So maybe I don't want to be as risky in the stock market. I get higher returns in the stock market, but it's with increased risk on my money. So as an investor, my first job is to preserve capital. So where can I go and put my money to get pretty much a guaranteed return and some stability? Well, I can invest in US bonds because the US government is strong, right? The US economy is strong. The US dollar is the world's reserve currency. So yeah, I might not be able to get double-digit returns, but if I can park $1 million in the US bonds and get a 4% return, lock in a 4% return over 10 years, meaning that I'm getting 4% by lending the government $1 million over 10 years. Every year I'm getting 4% on that. And then in that 10th year, they're going to hand me my $1 million back with an additional 4%. I'll park my money there and lock that in. So yeah, it's a modest return, but it's a return nonetheless. And so I have to diversify my portfolio when I'm seeing the tech sector get hit, right? When I'm seeing the S&P and the Dow, everybody taking a dive right now because of recessionary fears. I have to move my money around, right? So that's why you see the bond yields starting to flip. This is why you see things like this has changed now. So we've got an earthquake shake Dutch province, okay? But this is why you see things like the S&P has started to move down again. Why? Because yeah, you got a temporary bounce. They were hoping that the US Federal Reserve was going to kind of lessen its hawkish stance and not raise rates as aggressively. Well, economic data doesn't support that. So if I'm Wall Street, hey, if a company is going to stop spending and expanding, their stock is going to devalue. It's going to push the stock market down. Okay, so it all goes together. It all goes together.